With Staples Business Advantage, you get the benefit of thousands of experts.
Plus optimizations powered by the latest technological innovations.
1 + 1 =
2.
3.
Whatever. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
G'day and welcome to Shares for Beginners. My guest in this episode is Evan McQuire, Partner and Managing Director at MF&Co Asset Management, which is a boutique investment firm specialising in wealth management, trading and education. Evan started out like me in the music and audio industry, but took the sensible and more financially prudent path into the finance industry instead. He reckons that he's a better broker than a drummer anyway. We covered a lot of ground from the crash of '87 through the tech boom of the late 90s and right up until now. But for me, the biggest takeaway is Evan's concept of single stock shock and how to avoid it. G'day, Evan.
G'day, Phil.
Tell us a bit about yourself.
Yeah, sure. I was born in Sydney in 1975. Lived in the inner west for a few years, then the inner city, which was great when I was a teenager. It was a good time back in the late 80s and early 90s in Sydney. You could go and see bands, and the old days when you had bands playing in pubs, you know. And yeah, so I started my studies in financial markets, and then I found the only way I was going to get into doing what I wanted to do, to be a private client advisor or a stockbroker, was I had to get some kind of experience. And I thought, well, the only way to do it is to move more from a back office situation and move into front office. Had a couple of contacts that said to me, if you do that, they said the best people to come through are the people that come from back office and move.
What was it that attracted you to the idea of equities in the first place?
Well, it's a good question. I was always fascinated by. I remember back in 1987, the crash of '87, and I was only 13 or something at the time, 12 at the time. But I remember it on the news because I remember a lot of mum and dad sort of talked about it a bit, and we had a family friend who was very much involved in. He was involved in a junior gold mining company that was listed, and through him I met a couple of other people. This is later on. Through him I met a couple of other people that were brokers, and I got to sit in the office, and I just became fascinated by it, just by the gyrations of the market, and I just found the whole thing fascinating around, having to understand companies and understanding sort of economics and cycles and flows. Now, I didn't think about that kind of stuff in terms of cycles back then, but I just found the whole thing very appealing.
So do you remember your first trade or your first share purchase?
Yeah, I do. It was Look Smart, this is back in the when the tech craze was happening.
What was that, about 98?
Yeah, 98, 99, yeah.
Mm-hmm.
I got into Look Smart. I was working at McQuire, if I recall correctly. McQuire was the lead broker to the IPO, to the float.
Oh, so this is a long time after even doing your course.
Yeah, I may have done a couple of little trades before that, but I think they were more junior. I can't remember, but the one that stands out for me is the Look Smart trade, because... What
was Look Smart?
It was like a search engine. So it was a search engine that made no money. It's unreal. Back then, everybody was jumping on anything that was tech. If it was anything to do with the internet or anything like that, people just jumped on it. And then look at financials. Financials, what are they, right? So people just went. It was a whole hype thing. But Look Smart looked appealing to me, and because McQuire was doing the float, I was working there, I thought, well, why not? I'll have a crack at the title. And that turned out to be very smart, because I doubled my money on that particular trade. And I didn't have a stack of money tied up into it, but I got a really good taste for it in terms of the process of researching and all that kind of stuff.
So, what is a share?
Okay, well, basically a share is you if you have 500 shares in BHP, well, you own 500 shares in of whatever's listed out there. So you own a very small chunk of the company. And you're privy to dividends if they're paid, and you're also privy to the ups and downs of the share price. It comes down to one simple thing. Companies need to raise money, people need to invest money. And this is the whole purpose of stocks in the stock market. So you basically own a bit of the company.
When a share is first created, a company first lists on the exchange, which is an IPO.
Yep.
Initial public offering.
Correct.
And so they're using that capital to build the business.
Correct. So they raise those funds, and they go out and use those funds to build the business, invest in people, invest in plant and equipment, whatever the case may be. So that's the whole purpose of a company listing, so they can raise capital and they can go and build their business and hopefully pay dividends to shareholders and make profits, and everybody's happy.
So are you looking at a lot of that information when you're making a decision to buy or sell shares?
I use a mix of both technical and fundamental analysis. I'm more technical than I am fundamental because accounting is an art. You can move this here, defer that there, put this over here. So I price action tells me everything. Fundamentals are important. If they're making money, that's fantastic.
I think we're going to have to go back a step here because we've already come up with fundamental and technical analysis, which no one's going to know the difference. But if we can just sit with fundamental just for a moment, because you've talked about a share using capital to build and invest in the business and to grow that business.
Yes.
So fundamental analysis is when you're looking at the actual figures of the business?
Yes, you're looking at profit and loss statement, balance sheet, cash flow, all that kind of stuff. Price to earnings ratios. We're not going to talk about all that funky stuff. but that's the fundamental side. So that's looking at the numbers and analysing the company's performance. Technical side is where we use charts to be able to...
and what's a chart?
Okay. So a chart is you could say, a visual representation of the price action of a particular security. You can have charts on stocks, currencies, whatever the case may be, but we'll stick to stocks today.
And shares are often called stocks as well.
Correct.
Yeah,
yes.
In America they're called stocks more than...
Here, shares, stocks, they're kind of,
interchangeable, yeah.
Exactly right. So that's more of a graphical representation over a period of time as to how the stock has or share has performed.
What's some of the mistakes that you see first-time investors making? I mean, if you had one thing to say to a first-time investor to watch out for, what would it be?
There's a number of different factors that come into it, and the first one is don't get emotional about it. You have to be very careful because a share or stock is what it is. It doesn't have feelings or emotions. It doesn't care who you are. It doesn't know you. It's a stock. It's a share. But people tend to get in this whole thing that, I've bought this and it has to go up. And it just doesn't work like that sometimes. And, if you're somebody in the last couple of years and you thought, I reckon AMP looks good here, and you're looking at it today, that's a very different story. And you have to ask the question, well, what's fundamentally changed? You know what I mean? So there's a whole lot of things that come into it. But in terms of, to answer your question, people get emotional. They don't really understand what they're getting into, as in, have they really done the right due diligence on the actual company they're investing in? Have they been tracking the price action for the past 12 months, 3 years, 5 years? So there's a number of different things that I see, but the first one is where people get sort of emotionally attached in this sort of psychological thing where they go, I've bought it, it's got to go up, why is it going down? Or they buy it, and there's another one where you get somebody who's bought a stock, let's say it's a junior mining company or something, and they've got lucky and it's gone up 30% in a week. Take it off the table, take the profit. Yes. And they go, okay, well, I'm actually pretty good at it, do it again, and they make 10%. They go, I'm a genius. And then they do the same thing with a different stock and they lose 40%, they hand it all back. So it's, and it's like, how can this be? It's meant to go up. It doesn't always work like that.
People buy and sell shares in the share market via a broker, and there's full-service brokers. You're a full-service broker.
Correct.
And there's the online brokers. You can go through E-Trade or ComSec or whatever and make all your own decisions without any advice.
Yep.
Can you just talk a little bit about that, the different kinds of brokerage that's operations that are available?
So with the online side of things, you're getting no advice. You're on your own, and you place your order. That gets put through into the market via an automated system with filters. Nobody really helps you unless you've got a problem with logging in. You call up, it's up, can't log in. It's like you call up and say, I bought CBA and it's gone down. What am I going to do? Can't help you. End of conversation. With what full service advisors, brokers that talk to clients, the difference there is that you've got a person that sits in front of a screen day in, day out, has access to a lot of information and can help a client navigate the market, companies and help in the decision-making process around what you should or shouldn't be doing.
I think some people go to a broker expecting them to make money for them all the time, every day, in and out. But that's not how it works.
No. And again, it is a lot about managing expectations, education. It's about being able to sit there and say, look, here's an opportunity. There's no guarantees, but we feel there's an opportunity here. And you present that in a way, and you make it very clear to your client what can and can't happen. So, and so, for example, if it's a stock, we say, well, general advice is that you should buy this particular stock. These are the reasons why we think you should buy it, and these are the risks. That's basically it. I mean, you just, again, the managing expectation side from my angle is very important, because there's no guarantees. If you want a guarantee, go and buy a fridge at Harvey Norman.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
When you first started in the share market in the 90s, that would have been that golden era of the floats, when AMP and TAB and CBA and all these
that was
big
nice.
names, they floated.
Yeah.
And we've got that term mum and dad investor.
Yeah.
Do you think mum and dad investors still exist, or have they become smarter?
They still exist, and they have become smarter. I guess one of the benefits of technology is that everybody can get access to the same information at the same time. But what I've found, Phil, over the past few years is that, sure, the online domain is there. Is that a threat? No way. Not a threat to what I do or what we do, because what happens is people blow up at some point in some way, shape or form.
And blowing up means?
It means that they've lost money, and they've capitulated. They can't take it anymore, and they just go, that's it, I'm out. And they shut the trade, and they have $5,000 loss, $50,000 loss, whatever. And they go, geez, I see the virtues of investing in shares and stocks, right? But I just don't have the stomach for it. I can't deal with it. I'm busy with work and kids and running around, the dog and all that kind of stuff. So I go, you know what? I need to put this back to somebody who can sit there, watch it, and monitor it for me. And that's where we come in. Guys like me come in, that's what we do.
It seems to me that the market's a little bit like going to the beach. People don't even understand the forces that are acting. You're just sort of splashing around in the shallows, having a really nice time, and then suddenly the undertow takes you out. You're out in a rip, there's sharks out there, there's a whale, there's tsunamis, and you just can be buffeted around.
Yep.
What are some of these bigger macro influences that can affect the share market?
Well, I mean, there's a number of things. I mean, there's the political side of things, geopolitical side of things. The biggest thing for me, and has been in terms of the way that I view the world over the past, the biggest thing for me has been interest rates. That's the thing that really over the past 10 years, even if you look at Australia, why are we still at emergency level interest rates? Like, why? I mean, it's 17, 18 months we've been at these levels. And again, it's all about creating liquidity, really. It's about people being able to borrow money and invest and all that kind of stuff. But helicopter view, to answer your question, it's political, geopolitical, commodities, interest rates.
Why interest rates, though?
Well, because it means it's the ability for companies to be able to borrow money.
So is this like the RBA decision? Every month we hear about the RBA and keeping the interest rates
and
in
the
a
Fed.
particular... And the Fed is in the United States version of that.
That's right. So and so obviously, and it affects everybody. It affects your mortgage payment, your credit card, your business loan. I mean, and again, it's about the ebbs and flows of money, liquidity.
So a company might have it costs them more to operate. Is that what's
well,
happening?
Yeah, and the ability for them to be able to get access to money at a particular rate, and that's the thing that for the last. I mean, it's the thing. A lot of people have asked me recently, why is the market coming off? And obviously, we come off. The US comes off. We come off. You know what I mean? It's just the way it is. Not necessarily all the time, but that's generally as a rule of thumb. But yeah, so there's a whole raft of different things that come into play. So yeah, you can be at the beach and you go, this is pretty comfortable, and then there's a big wave that comes and it dumps you, and that could be something happening geopolitically, big spike in commodity oil prices. Hurts consumers. So there's a whole raft of different things.
And it's also the emotions of everyone, because it's like there's millions and millions and millions of decisions being made at every moment in the share market.
Yes.
And it's the accumulation of all those decisions which determine the price of the market at any particular time.
That's exactly right. So
what's some of the emotions that are going through those players?
See, this is where it gets interesting, because, so for example, when the GFC happened, and I was in front of screens then, I was an advisor, I was running a desk at the time. I mean, the price action was just, for want of a better word, was breathtaking. I mean, you'd sit there and you'd just be watching stuff like McQuire Bank go from 25 to 20 to 18, and you just sit there and go, wow, this is pretty amazing stuff. But what happens is that there's a number of things that happen, but in very simplistic terms, people get to a point where I can't handle it anymore. Stops get triggered. So there's stop losses that are out there.
What is a stop loss, just quickly?
A stop loss is where there's a determined level for an investor or a shareholder or whatever to get rid of that particular stock. That's the price that they go, that's it, if it gets to this point, I'm out. And they liquidate, they sell.
So that's one of the factors that's affecting at that particular time when the stocks are going down.
That's right. And then you've got things like, for example, I go back to GFC, you had a number of people that had margin loans. That's where you borrow money to invest in stocks. And margin loan goes into a buffer. And then you get a call from the margin lender that says, mate, top up or you need to chip stuff out. People start chipping out, and then that accelerates. People are selling because they've got to get out, as in, I've got to get out. Margin lenders are calling saying, you've got to sell or top up. I've got to sell. Machines start getting into the action. Predatory type behaviour like shorting, I don't think it's predatory, but people short. It's a function of the market. You're allowed to do that. So you get all these things that happen. And now, because of the speed of things in terms of electronic trading, things happen so fast that you can look at the screen and then 10 minutes later go away, make a cup of coffee, come back and have a look at the screen and go, what happened? BHP just dropped 60 cents. What happened? That was, when I first started, you didn't see lots of big fast moves like that, but now we've got lots of electronic trading, lots of machines, algos, bots, people. There's a whole raft of different people in there now, and different participants, if you will, that are in there, and things can move around really, really quickly.
So during that time, how were you feeling when you were watching those? What were the emotions you were feeling? We were very, look, from 2000 up to about 2007, 2008, when we started to get these cracks in the US, everybody made money in equity markets. Between 2000 and 2007, 2008, it was hard not to make. If you invested in the BHPs of the world, the CBA, you made money. And, you got dividends and all that kind of stuff. So you felt pretty good about yourself?
Absolutely. Things as an advisor, everything we did at the time worked. Clients were making money, we made money, everybody was making money. And then when the cracks started to appear, in 2008 it started. And then we got maybe it's not as bad. But there's a whole lot of things that happened, and then obviously the market just absolutely capitulated. I got to say, because I found it fascinating, extremely exciting. I felt bad for a lot of people because a lot of people got absolutely slaughtered. But in that time too, there was opportunity. There was a really good buying opportunity there for a lot of people. And if there's a saying, fortune favours the brave. If you got your timing right, some people picked up a lot of companies very cheap. And if they've held on to them since then, they would have done very, very well. Not all, but you know, I mean, for example, McQuire Bank. If you bought McQuire Bank at $18, you've knocked it out of the park. But then there's companies like Babcock and Brown that don't exist anymore, which is seen as a mini Macquarie. Gone.
Just completely, yeah.
Gone.
Yeah.
You know, Orco Finance, gone. So there was a number of, and even broking firms. We had a broking firm called Opus Prime, I think they were called. They went. There was Tricom Equities, massive broking firm. They had a big margin lending book. Gone.
And this is where analysts most probably have been saying these are good companies, and they've had recommendations on these companies. Yeah. So you really can't trust anyone, can you?
Well, yeah. I mean, again, it's difficult, and look, that was a very unusual time when the GFs. There was a number of things that, unfortunately, Australia, like the rest of the world, got sort of dragged into it because there was just this whole thing about the US potentially is going to blow up, and obviously all the authorities over there and the Fed and Hank Paulson and all those guys got together, created TARP and saved it. And we obviously got dragged into it. But yeah, I mean, if you're an analyst and you're sitting there going, Babcock and Brown's a buy at $7, and you acted upon that recommendation, well, that $7 became zero.
And this is a kind of a warning for potential beginners in the share market, isn't it?
Yeah. I mean, you look, again, there's no guarantees with anything, but what you need to do is you need to do your due diligence, and you got to look at the company. You got to look at what does the company do? Can they survive? Is there going to be some two kids in a garage somewhere that are going to make that particular company obsolete in 6 months' time? That's probably more about the IT side of things, right? Mm. And again, if you get into things like you look at companies that are into are in manufacturing, is there going to be a requirement for it? Is there going to be equipment that could make that particular piece of machinery obsolete? Mm. There's so much information, and again, you need to be able to do the due diligence and sit there and go, okay, what does the company do? Okay, is there a demand for what they do? Okay, do they have competitors? Yes. Okay, what about is there a regulatory side of things that affects what they do? Do politics come into play? If there's a change of government, does that affect? So there's a number of things you got to consider if you're a first-time investor that you need to be mindful of.
So this first-time investor, if they're just wanting to learn about the share market, and do they even have the skills to do that kind of due diligence?
Oh, I think so. Yeah, I think, again, because there's so much information out there. I mean, all you do is you go into your Google and type in whatever, so Telstra. So you see the company there, and then, or if you type in Telstra broker recommendation or something like that, you're going to find information. And, you can always just have a look at the company's annual report and updates and all that kind of stuff. AGM. I mean, there's so much stuff there that people can get access to relatively quickly. But, you don't know. You can have a change in government, you can have a change in some policy, or, some directors paid somebody off and now they're caught out and there's a litigation. There's so many things that can happen where you could have done your best in terms of your research, and then you just get that moment that happens where something comes up and the company's under pressure and the share price is falling.
So you're basically trying to give yourself an edge by educating yourself on a company as much as possible. Is
Absolutely.
That's what you're trying to do?
I think so. I mean, if you're in my eyes and in my view, there's different people that are in the market. There's long-term investors and there's shorter-term investors and people that speculate. If you're somebody who is more of a longer-term investor, then yes, you need to make sure that you're doing your research and you keep on top of what you're doing with the company. You monitor what's going on.
Well, this is what I wanted to come to, because the ASX 200, which is the top 200 stocks on the Australian share market, it's broken up into sectors.
Yes.
What are those sectors, and would you recommend having a share in each of those sectors, for example?
Probably not, because it depends on how much money you've got.
So what are the sectors? There's financials,
there's industrials, there's consumer staples, there's healthcare, there's telecommunications. So there's a whole raft of different...
and then there's sub-industries.
Yeah, correct. That's right. But to keep it very simple, so for example, if we're talking about financials, we're talking about banks, insurers, and the like. We're talking about resources. We're talking about mining companies generally, and also so the guys like your BHPs, your Fortescues, your Rios. Telecommunications, well, we don't have many, unfortunately, but we've got obviously Telstra. We're not like the United States; it's very small. So so that's what all those particular industries, those indices make up all these.
So an investor needs to be aware of which sector they're generally in, because there's forces acting on those sectors.
That's exactly right. That's exactly. So again, to answer your question, you want to spread your risk around. Don't be too loaded up in one particular area. Allocate your money in a way where you're not going to get smoked if you're too heavy one way. Don't bet your farm on one particular stock. Spread it out.
Do sectors tend to move together?
Not really.
Oh, sorry, in the shares within a sector, do they tend to move together?
Yeah. So if you've got, for example, if you look, for example, in the financials, and all the banks are coming off, obviously that particular sector's coming off, and anything that's pretty much in that sector, if you've got a whole bunch of them coming off, it's all coming off. And it works the other way. So, if there's a big run up in commodity prices, and that the materials sector will tend to, you'll see Rio, Fortescue, Newcrest, all those guys move higher. You want to make sure that you have a very good understanding of the sector, that particular stock or share that you're investing in. You want to make sure that you understand the broader sector that it's active in. When news comes out, you just got to make sure that you're on top of it, because again, things can move very, very quickly.
It can, and this is something that I've noticed, is there are so many news events that will affect it, and even just being across when these news events come about. Where can people find that information?
Oh, there's a number of different websites. I mean, look, you can go to the Australian Financial Review, AFR. If you can subscribe to that. Even Yahoo Finance, Google Finance. There's a number of different ways that you can get prices. Even the ASX website. You go to the ASX website, and you're going to get delayed data. If you don't have an online platform or anything like that, you get delayed data, and you get access to all the company announcements. So there's so much information out there. All you got to do is just do a little bit of research, and you can find what you need, and then you set it up in a particular way where you go, this is what I use to monitor the news flow or my portfolio and that kind of thing. But a lot of people these days, if they're trading online, for example, they'll have all that there. And then, of course, if you've got an advisor, well, the role of the advisor is to make sure they're monitoring things, and to give you a call and say, listen, there's just been an announcement, so I'll let you know. Stocks up, stocks down. And
then, of course, the important thing is about the emotion as well, keeping the emotion out of it. Is that correct?
Yeah, absolutely. I mean, again, where that becomes problematic is where you've had, in my opinion, for example, if it's somebody who's allocated a lot of money in their portfolio to a particular stock, and they go, well, I bought AMP at $4. Can't go any lower. You want to bet? And they go, how can this be? This is AMP. It's one of the oldest insurers, life insurance. How can this be? It's top 200, top 50 stock. This can't be happening. You just gotta understand that that's part of the gig. It becomes problematic if you allocate a lot of money to it, and this is why allocation in a portfolio is very important. You've got to make sure you're not too skewed in one way. If you're trying to build a portfolio, you want to have it diversified. So you're not what I call getting single stock shock, where you've actually got different things that are working. For something might be down, but you've got something else that's up, and it's balancing itself out. And then hopefully in the longer term, if you're more of a longer term investor, that all moves higher, and you're privy to the dividends and the good times, and obviously the bad times here and there, and it works for you.
That's a great term, single stock shock.
Single stock shock. Hopefully I can trademark that. Single stock shock. Well, it's actually a big problem, because what happens is that if you have a portfolio, and you can have 2 or 3 stocks in a portfolio, and let's say for example, AMP, Telstra and Myer. You look at those stocks and the price action of those stocks in the past year has been, I mean, if you had those three stocks alone in your portfolio, you are getting smashed. And you just sit there and go, my God, what's happened? So, this is where you got to, and this is the thing, like, you got to spread it out. If you like somebody's gone, I'll buy Myer at $1, it's already come off from $2, can't go any lower, want to bet.
Mm. So that's another trap, isn't it?
Absolutely.
What's the term, catching falling knives?
Yeah.
Tell me about that.
Well, I mean, people sit there and go, oh, well, Telstra's gone from $6 to $4, it can't go any lower. And it's the whole thing of, well, the stock's falling. I don't think it's going to fall much more. I'll buy some here, and then it just keeps falling. And the trick to get around that, the only way to really get around that is you got to wait for the price action to stabilise first, and then you start to see an uptick, and you start to see price action stay at a particular level. Doesn't always necessarily mean that it's going to go up, but you want to start to see volume coming through, and you want to start seeing a bit more confidence. That's when you, even if you've missed 20 or 30 cents, you go, I could have bought at $3, now it's $3.30. But it's better to buy it at $3.30 and to be there and the stock's at $3.70 or $3.80 in a year's time than to be buying it at $4 and you're still a year later and you've picked it up at, you know what I mean? It's still
so you were talking about price action and volume
yeah.
as being a factor of confidence.
Mm.
How does confidence in a particular share, is that how it expresses itself?
Yeah, I mean, and also fear. I mean, look, the two main drivers of anything, markets and life, in my view, fear and greed. That's what drives people, fear and greed. Fear of loss, fear of missing out, greed, I've got to get more. It's a driver, and I think that's a lot of that is very, very prevalent in markets. Doesn't matter if it's gold, oil, currencies, Bitcoin, doesn't matter. But what you want to see in terms of, well, there's two things. If a share of stock is coming off in a significant manner with lots of volume, there's a problem. And vice versa. If you're seeing stock go up and there's lots of volume behind it, that's a good thing. It means that people have got conviction, they're confident, people are buying, and when you see volume, that's telling you a lot. Volume is key. Volume is key because that tells you a lot.
Liquidity. You were talking about liquidity before.
Yep.
What's that mean?
It means, in my world, it means the ability to be able to get in and get out, basically. Liquidity and around, and that's in terms of what I do with stocks and options, right? But also, you can also use that term in terms of how much money is in the system. You
want liquidity in a share.
Absolutely.
So tell me how that works.
Well, so for example, BHP, lots of liquidity.
There's lots of money going in and out.
Lots of money going in, lots of buyers, lots of sellers, lots of activity. And then you could have ABC Mining Company, which doesn't exist, but that's just an example, that doesn't trade much at all and isn't a lot of volume on the bid or the offer. So if you needed to do something, it could be difficult for you to do it.
Mm-hmm.
So that's what I mean by that, by liquidity. Yeah.
Okay, now we're talking about analyst recommendations.
Mm-hmm.
There's a whole range. There's buy, hold, accumulate, reduce. What do those all mean?
Okay, so buy.
Because it just means you think, isn't it just a buy or a sell?
Yeah, well, you'd think that, but
but you'd be wrong.
So so buy obviously is buy. Sell is sell, get rid of it. Reduce is don't get rid of all of it, but takes them off the table. Hold is just hang on to it. Don't buy anymore. Don't sell anything. Hold.
And accumulate?
Accumulate means to add. You could say it's the same as buy, but it's more if you've already got some, you'd accumulate, you'd add a bit to it. Yeah.
Evan, this has been great. I've learned so much today.
Thank you for inviting me. I've thoroughly enjoyed it.
For more information, we can go to your website, which is...
Yes, the website for MF & Co Asset Management is www.mfam.com.au.
And don't forget, if you get in contact with Evan, please mention beginners. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any shares based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's break room easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.